Okay, let's dig into this. You've just got your mortgage, ink's barely dry, but maybe you're already seeing better deals pop up. And you're thinking, how soon can I actually jump ship? Can I refinance, like now?
That's the million-dollar question, isn't it? And technically speaking, maybe. But should you? That's what we're exploring.
Exactly. So is it even possible right away? Or, is there a smarter way to time this?
Right. We'll look at what the article suggests about, well, the difference between technically being able to apply almost straight away and the strategic reality of when it actually makes financial sense for you.
Okay, so our mission today is basically to cut through that noise, understand the factors that make refinancing worthwhile, the potential downsides of doing it too early, and really figure out how you know when the time's right.
So let's jump in. Technically, the article confirms you can often apply to refinance very, very soon after settlement, like potentially the next day in some cases. There usually aren't hard and fast rules forcing a long wait.
Okay, so that's the can. But then comes the should, and the article seems pretty clear about maybe hitting the brakes.
It really does. Just because you can apply doesn't guarantee a new lender will approve you, especially so soon. And even if they do, the costs involved might mean you're actually worse off initially.
Right. So the article actually suggests waiting. How long?
Yeah, it generally points towards waiting at least, say, 1 to 2 years after getting your initial loan. And it lays out some really solid reasons why that wait is usually beneficial.
Okay, let's break those down. What are the big practical hurdles the article talks about? Why wait?
Well, the first one, and it's a biggie, is simply cost versus savings. Refinancing isn't free, not by a long shot. The article lists quite a few fees you'll likely face. Things like a discharge fee from your current lender.
To close the old loan.
Exactly. Then application fees, maybe setup fees with the new lender, valuation fees to check your home's worth again, government fees for sorting out the title deeds, and potentially, if you're on a fixed rate, hefty break costs.
Wow, okay. That list, it adds up fast. So the article implies you could actually lose money at the start.
Precisely. If you jump too soon, all those upfront costs can easily eat up any savings you might get from a slightly lower interest rate for the first few months, maybe even the first year or two. You've got to reach what the article calls the break-even point. That's where your total monthly savings finally overtake the total amount you shelled out in switching fees.
And that takes time. So rushing could mean being financially behind for a while.
Absolutely. Then the next really critical factor the article brings up is building equity and improving your loan-to-value ratio, your LVR.
Right. When you first buy, your equity is basically your deposit, maybe a tiny bit more.
Exactly. Waiting gives you time for two things to happen. You pay down a bit more of the loan principal with each repayment, and hopefully your property value increases over that time as well. Both push your LVR down.
And getting that LVR down, ideally below 80%. Why is that such a game changer for refinancing, according to the article?
Because, and this is crucial, if your LVR is still above 80% when you refinance to a new lender, the article says you'll almost certainly have to pay lender's mortgage insurance, LMI, all over again.
Oh, wow. Not just pay it once, but potentially pay it twice.
Yes. And LMI isn't pocket change. We're talking thousands, sometimes tens of thousands of dollars. So refinancing just to save a bit on the rate, only to get slugged with another huge LMI premium. It often wipes out any benefit entirely. Getting below 80% LVR is key to dodging that massive cost.
That LMI point is huge. Just throwing away thousands because you switched a bit too early with a high LVR. Ouch.
It really is a major practical barrier. Beyond the costs and LVR, the article also flags the impact on your credit profile.
Okay, how so? Applying for loans, that affects your score.
It can, yeah. Every formal application usually triggers what's called a hard credit check, and that gets recorded on your file. If lenders see multiple applications close together, especially right after you've taken out a big mortgage, it can sometimes look like you're scrambling for credit or maybe financially stressed.
Excessive credit seeking, is that the term?
Something like that, yeah. The article suggests waiting helps avoid that perception, keeps your credit history looking a bit cleaner, which is better for any future borrowing.
Got it. And there was one more factor, market changes.
Yes, market fluctuations. The article warns about the risk of becoming a mortgage prisoner.
A mortgage prisoner? What does that mean?
It means if you refinance early, maybe stretch yourself a bit, and then the property market dips significantly. Your LVR could suddenly shoot up, maybe even go over 100% in a worst-case scenario.
Oh, right. So your loan is worth more than your house.
Exactly. And if that happens, forget refinancing again anytime soon. Even if amazing deals come along, No new lender will want to take on that risk. You could be stuck with your current lender and potentially a less competitive rate. Waiting provides a bit of a buffer against those market drops.
So that 1-2 year window the article suggests, it's not a hard rule, but more like a strategic sweet spot.
That's a good way to put it. It gives time for savings to hopefully catch up with the fees, time to build that crucial equity, and maybe avoid LMI. Protects your credit file a bit and gives you a cushion against the market going south right after you buy.
Makes sense. But okay, life happens. What if waiting 2 years isn't ideal? Does the article talk about specific triggers for when might be the right time for an individual?
It does. While the 1-2 years is a general guide, the article points to specific events or changes that could make refinancing worthwhile sooner, or signal it's definitely time to look.
Like what? What should people be looking out for?
Well, the obvious one is a significant drop in interest rates since you took out your loan. If rates have fallen quite a bit, the potential savings might overcome the costs sooner.
Okay, that's straightforward.
Or if your fixed rate period is about to end, you definitely want to shop around before you automatically roll on to what's often a much higher variable rate.
Good point. Don't just let that happen.
Another trigger is building substantial equity. Maybe you've paid down a good chunk or the property value has shot up. That lower LVR might qualify you for much better deals. Or perhaps you want to access some of that equity for, say, renovations.
Right. Or maybe your needs have just changed.
Exactly. The article mentions needing different loan features. Maybe you now want an offset account to save on interest and your current loan doesn't have one. Or, frankly, maybe you're just really unhappy with your current lender's service. That can be a valid reason, too.
Sure. Or big life changes, new job, bigger family might mean a different loan structure works better now.
Precisely. The article really encourages reviewing your mortgage a regular thing, like an annual checkup, just to see if your situation or the market has changed enough to warrant looking around.
Okay, so let's say someone's listening, they've hit one of those triggers, and they are considering refinancing. What are the essential homework steps the article advises before they even apply anywhere?
Preparation is absolutely key.
Yeah.
First step, according to the article,
Yeah.
be crystal clear on why you want to refinance. What's the specific goal? Lower payments, consolidate debt, get an offset.
Know your objective.
Yes. Then, gather all the info on your current loan, your exact interest rate, remaining term, monthly payment, and critically, if you're on a fixed rate, find out the exact break cost. Don't guess. Also, try to get a realistic estimate of your home's current value. That helps you calculate your equity and your estimated LVR. And check your credit report yourself first so you know where you stand.
Okay, got all that sorted. Then list all the potential costs of switching the discharge fee, the application fees, government charges, valuation, and crucially, factor in LMI if your estimated LVR is still looking like it'll be over 80%. Don't forget that one.
Absolutely vital. Once you have that full picture, your current situation, your goal, the potential costs, then the article says start shopping around. And look broadly. Don't just check the big four banks. Look at smaller banks, credit unions, online lenders, non-bank lenders. Compare rates, yes, but also compare fees and features that actually matter to you.
And before you sign on the dotted line with someone new, call your current bank.
Definitely. The article strongly suggests this. Tell them you're considering refinancing. Mention the better offers you've seen elsewhere. You might be surprised. They might offer you a better rate or waive some fees to keep your business. It can save you a whole lot of hassle and cost if they come to the party.
That negotiation step sounds pretty powerful.
It can be. The article also mentions considering a mortgage broker. They know the market, they can often access deals you wouldn't find on your own, and they handle a lot of the legwork.
Right. And one last really important point the article makes. Be careful about the loan term on the new loan.
Yes, this is critical. A new lender might tempt you with lower monthly payments by suggesting you reset the loan term back to 25 or 30 years. But the article warns, doing that means you end up paying significantly more interest over the total life of the loan, potentially tens or even hundreds of thousands more.
Oof. So the lower payment feels good now, but costs you way more long term.
Exactly. If possible, try to keep the new loan term similar to what's remaining on your current loan, or even shorter if you can afford it. Think total cost, not just the monthly payment.
Okay, so wrapping this up then. While the article confirms you can technically apply to refinance almost immediately after settling, the smarter move generally is to wait at least 1-2 years.
Yeah, that strategic pause lets potential savings actually start to outweigh the switching costs, helps you build that vital equity to hopefully get under 80% LVR and avoid paying LMI again. Plus, it protects your credit score from too many hits early on and gives you a buffer against market dips.
But finding the right time is personal. Look for those triggers. Significant rate drops, your fixed rate ending, building substantial equity, or maybe just needing different loan features.
And when you do consider it, prep is everything. Understand all the fees, shop around widely, try negotiating with your current lender first, and be really strategic about that loan term. Don't just reset to 30 years blindly.
So this deep dive leaves us with a couple of things for you to think about. Firstly, how do you weigh that understandable desire for immediate saving, those lower monthly payments, against the total costs and potential risks over the entire loan?
And looking ahead, maybe think about what small practical steps you could take right now. Maybe paying a tiny bit extra each month, or checking your credit report to improve your equity or credit profile. That could make future refinancing easier or more beneficial when the time comes.
Good questions to ponder.
And finally, if you happen to be an Australian expat specifically looking into refinancing your mortgage back home, Odin Mortgage specializes in helping expats navigate that process and secure competitive deals no matter where you are in the world.